You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here, we do strategy. 5 minutes on the clock. Let's get to work.
The news today is not just a headline, it is a regime change. As of this morning, January 13th, 2026, the United States Department of Justice has opened a criminal investigation into Federal Reserve Chair Jerome Powell. The official pretext is an inquiry into office renovation costs. Do not be naive. The market knows exactly what this is. This is a kinetic action by the executive branch to break the independence of the central bank. The goal is clear: force the resignation or submission of the chair to secure aggressive interest rate cuts. The market's verdict was immediate and brutal. Gold futures violently repriced, smashing through all-time highs to touch $4,614. Silver miners like Hecla and Newmont are surging. The dollar is weakening. The message from the capital markets is unambiguous. The era of the non-political dollar is over.
Why it matters? You must understand the gravity of this shift. For decades, the global financial system has rested on a single pillar of faith: that the US dollar is managed by technocrats looking at data, not politicians looking at poll numbers. That pillar has just been demolished. If the Federal Reserve is captured by the executive branch, monetary policy ceases to be an economic tool and becomes a political weapon. Interest rates will no longer be set to control inflation. They will be set to juice the economy before elections and monetize government debt. When the referee starts wearing a team jersey, the game is rigged. We are moving from a regime of risk-free return to return-free risk in sovereign bonds. The bond market, once the bedrock of global collateral, is now subject to the whims of political survival.
The hard truth is that your safe portfolio is now the most dangerous thing you own. The conventional wisdom of the 60-40 split, 60% stocks, 40% bonds, relies on bonds acting as a hedge when stocks fall. That correlation breaks when inflation is the driver. If the Fed is forced to cut rates while inflation is still sticky, bonds will not protect you. They will bleed purchasing power alongside your cash. The market is voting with its feet. Smart capital is fleeing the political dollar and moving into assets that cannot be printed by a decree or investigated by a prosecutor. We are seeing a flight to sovereignty, not sovereign debt, but sovereign assets. If you are sitting in long-duration government bonds hoping for a safe yield, you are effectively shorting inflation in a world where inflation has just become a political mandate.
The actionable move. We do not panic, we adjust. Here are your 3 tactical steps to fortify your position against the politicization of money. Number 1. Construct a sovereign shield with non-political assets. You need exposure to assets that have no counterparty risk and cannot be debased by a political appointee. The breakout in gold to over $4,600 is a signal, not a bubble. But the tactical play here is the miners. Look at the producers with strong balance sheets who are currently printing cash at these spot prices. They provide leverage to the underlying asset.
Number 2. Short the long end of the curve. If the market believes the Fed will be forced to cut short-term rates prematurely, inflation expectations will spike. This will cause long-term bond yields to rise as investors demand a higher premium to hold long-term debt. This is called bear steepening. You do not want to own long-duration bonds here. You want to be positioned for yields on the 10-year and 30-year treasuries to rip higher as the vigilantes return to punish fiscal indiscipline. Keep your fixed income duration short, extremely short, T-bills only.
Number 3. Audit your real yield. Stop looking at the nominal interest rate your savings account or bond fund pays you. It is irrelevant. You must calculate your real yield, the nominal rate minus the actual rate of inflation, not the government CPI print, but the cost of the assets you actually buy. In a regime of political monetary policy, real yields will likely be deeply negative for a long time to subsidize government borrowing.
If your cash is not earning at least 200 basis points above the real inflation rate, you are bleeding capital. Move that liquidity into productive assets or short-term high-yield commercial paper from fortress balance sheet corporations that are now more creditworthy than the sovereign.
The printing press can create currency, but it cannot create value. Position yourself accordingly. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. This content is not a substitute for professional, financial, investment, or legal advice. Always consult with a qualified professional before making any financial decisions.